Welcome to Disruptive Successor, a show for next generation leaders in family businesses and entrepreneurs who want to disrupt the status quo and take their existing business to a whole new level. We all know that what got us here isn't going to get us there. This show will provide inspiration, advice, and resources to help you create massive impact.
Hi, this is your host, Jonathan Goldhill, and welcome back to another episode of the Disruptive Successor Show, a podcast by, for, and about family businesses. And as you know, I've been hosting a number of experts, family business consultants, advisors, and people who have been in the trenches. And today I have a special guest, local to me. He's in Santa Barbara, California, originally from Michigan, and ran a multi-generational family business, and then became a consultant outside of the business, working for Deloitte Consulting, and became a partner in that organization. George Isaac is now the founder of GAI Capital, which is a specialty family business consulting practice, and he is focused on business valuation creation and longevity. He's focused on succession planning and governance, family dynamics, wealth management, and transfer. And he has written this fabulous book called Your Business, Your Family, Your Legacy, Building a Multi-Generational Family Business That Lasts. So George was the Gen 3 CEO of his family's manufacturing business, which grew revenues sixfold over 8 years. He's also served on 15 corporate boards. He's written articles in magazines like Tharawat, Trust and Estates Journal. He's been published by CNBC, Family Business Magazine, and he has an MBA with distinction. This is the man who has a lot of answers to your questions. And so we're going to start with welcoming George Isaac to the show. George, thanks for being here.
It's great to be here. It's always fun to talk about family business issues. It's never a dull moment, and I get a lot of pleasure from sharing ideas with, and I'm looking forward to our conversation, Jonathan.
Yeah, so tell me, speaking of never a dull moment, so you had risen to the ranks of partner in Deloitte Consulting, which is arguably like one of the best consulting, most widely recognized, highly reputation firms. And there was a turning point where you had turned down the offer of being a CEO in your family's business, and then they came back to you. And tell us what that situation was all about.
Well, if I take it back even a little further, I grew up in Ohio, not Michigan. I went to University of Michigan.
Right.
That's where I got to Michigan from. But small town in Ohio, my family's aunts and uncles and our house and the business was all on the same block in this little town. So I spent a lot of time being groomed, if you will, or programmed, might be a better way, to be a businessman, and particularly to be in the family business with my aunts and uncles and cousins.
And this was a foundry business, is that right?
We sold to foundries and steel mills. We're metals processing and recycling and manufactured certain products that would go into large-scale steel mill furnaces to make new steel and iron.
Okay.
Ironers. So companies like General Motors and U.S. Steel and Inland Steel and Ford Motor, and those are our customers. So it was large industrial based. And then we also had a real estate business that we had that was actively as well. So we had two basic operating companies at the time. In a kind of a classic sense, my father ran the business very, very well and grew it to a nice size, but he was very authoritarian in his management style. And so when you have that kind of environment, the people underneath, are typically waiting to get their next direction and not necessarily getting developed to be able to take over and run. So when I was at Deloitte, and it was before I became a partner, they asked me to come back. At first they thought I would come back right out of college and grad school. And I said, no, I want to get experience elsewhere. Loved consulting, loved Deloitte. We ended up with my agreement as well that I would not come back, and we'd hire an outside president to take over. So that was the first transition experience that I personally went through, was having an outside non-family member become president of the company.
And give us a little context. How did the other family members feel about that at the time?
Oh, well, they felt fine with it. I mean, I was pretty clear that I was not interested in the job, and they were not really, in the running for that job. They had their specific areas, and so I think they were looking forward to, to keeping the company. I mean, the other option which is so unfortunate, is when you don't have a succession plan in place or you can't put one together, quite often the best option is to sell the business, which is a terrible reason to sell a business. And so
Right.
we can talk about that later. But,
We will, yeah.
okay, so they were fine with that. But the irony is that over the following year, I had two cousins back there working, one for a long terms, and one of them was saying, this is exactly what the company needs. It's perfect. And this president's doing a great job. He's putting discipline in the areas that need to be more disciplined. The other cousins call me and say, this guy's destroying the business. He has no idea about the relationships and critical aspects of these long-term standing relationships we have in our industry. And he's ruining the business.
Right.
So they kind of cut through it. I went back and interviewed him and realized he wasn't the right fit for our industry. And so, they said, will you come back? And I said, well, okay. And it kind of was, I was a partner then, and the firm was nice to give me basically a leave of absence for 6 months, because the kind of impression was I would go down there and fix whatever needed to get fixing,
right,
and then come back and become a partner. I was a young partner. They didn't want to lose a partner.
Mm-hmm.
In any event, I went back and started running, enjoyed running the business, enjoyed rebuilding the management team and changing, a lot of the stuff that was being done. So that's kind of how I ended up as CEO of the family business.
And then you grew that business, you said sixfold over 8 years. Can you give us some numbers? So, because many of our listeners might think that went from 1 million to 6 million or something.
No, when I took it over, it was around 30 million. And I give credit. It went, kind of from 0 to 30 under my dad's watch. And I think that's a lot harder than what we did.
I agree. The first million, I think, is the hardest usually.
Yes. So I inherited a business. It had a strong balance sheet, not the kind of management team that would obviously grow it.
Right.
But it was, it was a nice business. And so we grew it through all the traditional ways, through, internal organic growth, through some acquisitions, some new products, services that we put together. But fundamentally, the key driver was building a management team that had the kind of talent set that would help us drive that ship that way. And so a lot of what I did was really kind of change out the management, team, and recruited people. And we moved the headquarters from a small town in Ohio to a relatively larger town, Toledo.
Right.
And that's where I was able to recruit better. And so we built a really good management team, and we had a culture of growth. It wasn't, like a lifestyle business. Well, you're doing 30 million in sales. We can all live nicely on that. Let's just enjoy it. We wanted to make our mark. My cousins and I, we decided that we were going to keep the capital in the business and grow it to show our appreciation for what we all basically inherited from our, fathers and brothers.
And so one of the things that I read in your book that I really appreciate, and I think you and I have a lot of similarities in our thinking, but is your concepts around, and you don't call it open book management, but I think you call it transparency around the numbers. And that's a big thing that I promote within my clients, is to have some transparency around the numbers. You really pushed like the production metrics down into the shop floor, it felt like, and that drove productivity greatly. Is that true? And can you speak to that a little bit?
Yeah, I think it was before that. Nobody saw the financials. It was,
right, of course, authoritarian management.
Everything's a big secret in these family businesses, and and so, it's like playing basketball and not letting the players see what the scoreboard is. I mean,
right,
time clock. I mean, it just doesn't make any sense. Now, I'm not saying you need to show your profits to everybody in the company, but my goal was to have metrics and measurement systems in place for the person that was responsible for an area, so they could run it like that little piece of the business was their business. They're the president of that little piece of the business.
Sure.
So that was the first step. Was we put budgets in where there weren't budgets, so we could have metrics to measure performance against, and manage the exceptions and the problems, and see the problems. The other thing I did was I made our problems very transparent. Like when we started talking about allocations and cost sharing, at times it's like, well, this division can afford this, so we'll charge the cost to that one. I said, absolutely not. We're going to call them just the way they are, because if we got a problem, we want to highlight the problem, not hide them.
Yeah.
So that was kind of a restructuring of the financials.
Yes.
What you're talking about was, and it's amazing example of reaching down in your organization and empowering people. And so we had 3 plants basically making the same production processes, among some other things. And one plant was struggling with the cost per unit. And so I said, let's take a look and do some benchmarking, understand what the problems are. So we had a meeting at our plant, and I had the vice president of manufacturing operations, the director of operations, the plant manager, and myself in this little room at our plant. And we're starting to talk about it. I go, well, where's the line operator, the machine operator? Well, he's down at the machine running it. And I said, well, who knows more about running this machine and the problems there are?
Right.
The guy that does it 8 hours a day.
Right.
Let's get him up. So they went out and got him out, and they told me, George wants you to come up, which, was a great, move just from their own sense of self-worth. Oh, the president wants to hear from me.
Right.
So he came up, and we found out stuff that was going on that was just mind-boggling. Like, you got to be kidding. We're like doing those dumb things, and there were some really, very fundamental things. So we worked with this line operator to set a standard of how much production should be done by shift. And we implemented reports down there, and he got his daily production. So when he goes home at night, he can feel good that he killed it today. He met his numbers, he beat his numbers. And the bottom line is, and it's the honest truth, we doubled production through that plant with no capital expenditure, just through better operating practice.
I think, I've seen this over and over with my clients, and it's about not hoarding knowledge, but sharing information and knowledge. And it's also about digging deep and asking those people, like, what should we start doing? What should we stop doing? What should we keep doing? And the classic SWOT analysis, like that is designed for managers to tell the leadership team, what's working really well and what's not working well, or what's broken or missing, and let them participate and get that information going up. So very interesting, and a good story, and a great learning lesson takeaway for anyone running a business.
Another one, Jonathan, if I may, on the administrative side. I mean, it goes down to getting your people engaged in the business and having them help lead and run the show. I walked by one of our accounting people, and they had a stack of paper about 1.5 feet high. And I'm like, what in God's earth is that?
Right.
Oh, that's what we send every month to General Motors for the business we do with them. And I'm thinking, there's no way in the world anybody at GM is reading this 1.5 feet full of paper.
Right.
They go, that's what they need. That's what they want. So I doubted that. So I called our guy up there and told him the whole thing. It was just ridiculous. Just stop doing it. So,
crazy.
I mean, that was a huge effort of time that was saved by just walking around and talking to the individual. And you got to get these people empowered so that they start challenging things. And that was part of the goal.
Yeah, I always love the books with the stories where the CEO is basically walking around and just having conversations with people, trying to understand what it is that they're doing, and gets them to start thinking about how they can make their jobs more efficient, while the CEO is learning about how effective that person is as well. So good story. Okay, so let's fast forward a little bit now. What's the status of the business today? Where did the business evolve to after you left?
Okay, so now we had 2 businesses to start with.
Mm-hmm.
Prior to that, my father had several businesses, so he was really entrepreneurial, and
right.
We ended up with these 2. The real estate business is now being managed by our 4th generation, with I think some 5th generation shareholders coming on board at least. So that's going to be the legacy business.
Mm-hmm.
The metals business we sold for basically to provide liquidity and basically to meet shareholder needs. And one of the things that we were very aligned in at the initial years and how we wanted to spend our capital and what our goals were. But as people got older, their needs changed. And I've learned some things since then that I would have done differently. But we had this policy of no distributions other than for taxes. So
that's great.
It's fine for, like, our family culture was, don't live well, live modestly, and save your money for a rainy day, and keep it in the business, and no debt. And it was this kind of classic conservatism, which you might want to talk about later because there's some problems with that.
I do want to talk a little bit about something, and I want to give a plug for your book, if I may, because in the financial chapters on your book, You, of course, talk about what everyone knows about, which is the profit and loss, and what most people pay some attention to, which is the balance sheet. And then there's the cash flow, which you call, the statement of changes. I'm sorry. No, then there's the statement of changes in equity, which is basically like the cap table. But you make the important point about how there should also be some recognition about what kind of shareholder returns and what does that statement look like on an ongoing basis. And because if you start to look at your business as a separate asset from yourself, as something that you're literally investing in, what is your return on your invested capital? Super important. And too many business owners, especially smaller ones, don't even begin to think about that.
Well, our returns were fantastic, right? We grew sixfold.
Right.
Except nobody saw a dollar. So the return on equity for the business and the value of their stock was great.
Right.
But
right.
They didn't get a nickel of it.
It was all paper gains. Terrible.
It was paper gains, and there's a lot of issues with. There's better ways to have done that. Since I left that business, I was in a public company. I did private equity investing. I learned several things that from those other experiences that I'd start thinking about what's relevant to the family business. And that's what I realized we didn't do it the right way. And it ended up creating, issues with alignment of shareholders. We were totally aligned to begin with, but after 7 or so years of this, it's like, well, nothing's different for us. And so one of my cousins came in and said, George, it's like we have this diamond.
Yeah.
And the diamond is going up in value. And we take the diamond and then we give it to our kids after we, of course, pay estate taxes. And now they have the diamond.
Right.
It goes on so forth, but there's no useful value.
Right.
In terms of our lives or anything. And so, there's quite a bit of writing in the book about stewardship versus financially conservatism. And I think a lot of families get those confused. And, if you want to talk, we can talk about that later, but that was one of the issues, was not distributing any returns for ownership. We had returns for employment, but the owners were not getting returns, and that created a liquidity issue. And so we got a great offer to buy the business, and it kind of solved that problem. So that's how that works. So we'd still have one long-term business.
Right. And then was that your first sort of insight into this concept that you call in your book the family business wealth evaporation trap? Was it in your business where you saw, wow, there's this diamond and it's just sitting there, but like it's almost at risk of going down in value or losing value against the inflation or something?
I didn't see it soon enough.
Right.
Kind of after the fact, in hindsight, I think it was more, it's much smarter in hindsight than I was in foresight. Mm-hmm. But that's one of my big stories today when I work with companies is to take them through that. When they think they have $25 million in cash on their bank account and no debt, and they're being good stewards and financially conservative, I'll say in a nice way, you are being very financially conservative, but I don't think you're being good stewards, because let's look at some different approaches. And if you, in fact, distributed some of those funds into other LLCs for the family, they could diversify their holdings, so you're not having all your money trapped in one asset class, and there's liquidity, and there's a whole bunch of things. So I learned that, Jonathan, to answer your question, through PE investing.
Right.
And the real estate guys get it. The real estate guys get it too, because they're refinancing
all the time.
The time on with the non-taxable refinancing, so they get it. But most of our guys in the operating business, they think their business is not part of their investment portfolio. If I say, tell me your investment portfolio, they start talking about stocks and bonds, and you ask about, what about your business? And well, that represents 80% of your net worth.
Exactly.
That's not operating company. That's not mine.
We all know that that's putting too many eggs in one basket, and that private equity is all about recapitalizing a company's balance sheet, so that if you're an owner and you're selling to a private equity fund, you're taking some money off the table and being able to diversify. Now you're able to take that cash that you get and invest it in other assets. So the wealth evaporation trap. So just explain to people what that is. Maybe by
example. Well, one of them is, I think when you have all your eggs in one, or 80% of your eggs in one basket, and you have all that money on your balance sheet, that's not, you don't have the right capital structure. And I'm a very conservative financial guy, so I'm not talking about leveraging things up.
Right.
But one case example, we had a client that had $30 million in cash, no debt, and around 50 million or so in inventory and receivables.
Mm-hmm.
So I would say to the CEO, well, what do you think you could finance those receivables for in a working capital line of credit? Well, probably 3.5%, or so. And I go, well, so you're taking your precious equity capital and investing in a 3.5% return asset, your receivables and inventory. If I brought you an investment like that, you'd throw me out of your office.
Right.
So what happens if we got working capital financing, and that would free up even easy 25 million. And I think in this case it was 27.5 million.
Right.
And then you have 30 million in cash in the bank.
Wow. Right.
Why don't we distribute 20? I mean, I didn't say 30 because the board was very conservative.
Right. Of course.
I don't know why we left 10 million in there. They have plenty of working capital line left, but we left it in there just kind of from an evolutionary, not a revolutionary approach in terms of implementation.
Mm-hmm.
So we can make it. So we distributed $47.5 million.
Wow.
Out of the business into another LLC that then they were able to invest in private equity and a diversified portfolio and with liquidity.
Right.
And it was all non-taxable because it was an LLC, so it was tax-free distributions. And when they say, well, what about risk? I said, well, we can put it all in government bonds if you prefer, but at least it's in an asset-protected entity. You can always put it back in. You can always guarantee loans for the operating company. There's a variety of things, but fundamentally, you control that capital and you're getting a return on it. So what happened was the returns on the business went up significantly because all that idle equity that was not returning anything, like the cash in the bank at 30 million, was getting 0.5%.
Yep.
That's now getting whatever they're getting on their investment portfolio. So it was a huge difference, and it worked really well. And then on an ongoing basis, they take a look at that and figure out what they might be able to continue to do, or if there are needs in the business, you leave it in the business. But that's a major thing. The other part of the evaporation trap was, and that gives you diversification. So it gives you diversification, liquidity, and better returns on your equity capital. And the thing we just talked about, realizing returns. If we're distributing out to the shareholders or to another LLC, it can go to the individuals or it can go to a captive, company to do investing. And then the last part of wealth evaporation is when you sell the family business. I mean, there are times when it makes sense to sell the business. That's when the outlook doesn't look good, or you get a ridiculously attractive multiple, which they're out there these days.
Mm-hmm. What would you put a number to that, just so people understand?
A ridiculous multiple?
North of 10 times? Okay.
10, 12 times EBITDA. I mean, that gets, then it gets into, from a financial perspective, because when you sell your business, as you know, you're going to pay taxes to Uncle Sam, and that could be a third, depending upon the situation.
Yep.
You have 2/3 of the capital now after you sell the business to get to work for you. And if you're selling it at 5 times EBITDA, 5 times cash flow, that is like a 20% return and it's tough to get a 20% return in the market. If you're selling at 10 or 12 times EBITDA, then that's, it's a 10 or 9, 8% return, that might be comparable. But once again, you're working with 2/3 of the capital base. So the wealth and the cash flow after that can be significantly less than what you're currently enjoying, including it doesn't account for your salaries and perks and office. And so selling the business can be a wealth evaporator if you're not careful. And I think my point is that I think you can get the best of both worlds. I think over a 5 or 7 year period, you can distribute enough cash trapped in the family business to get that diversification and wealth, no longer evaporating without having to sell the business.
Makes good sense. And basically, people are buying the business; they're not buying the cash in the business.
Right.
So I'm not that familiar, but I imagine in most sales, the seller takes the cash with them. They don't leave it in the business. So they're clearly not buying the cash in the business. Okay.
Yeah.
So let's talk a little bit more about some of the pros and cons of selling a family business. I mean, you and I have both in our books talked about the statistics of how few make it to the 3rd and the 4th generation. So kudos to you and your family. My observation is that most family businesses that eventually transition into basically real estate holding firms, where they become family offices that are now investing in other assets, but are typically real estate heavy in their concentration, because real estate doesn't go away. People always need it, except maybe in a pandemic. But Let's talk about some of the pros and cons. I mean, obviously, one of the big cons is that the tax bite when you sell a business is going to be huge. There's a capital gains tax. There's
recapture taxes. There's state taxes.
Sure.
California, we know that real well.
Yes, we do. As we talk about raising those even higher, especially for larger income earners. So tell us some more about the pros and cons of selling a family business.
Well, I think, the financial one we kind of covered. It is a hit. And, there are times where it may make sense, but quite a lot of the times that I see, businesses are being sold not at those ridiculous multiples and for other reasons. There's family problems or there's unaligned shareholder objectives and so on. But I think the part that people don't fully appreciate is the personal impact. Because when you're part of a family business, that's almost, sometimes that's the family. That really defines the hub of the power and the control and the center of the circle. And there's people's self-identity and sense of self-worth. All of a sudden, they have no place to go. When you say, "What do you do?" Well, I'm George Isaac. I work at the Isaac Corporation. Well, that was, that's gives you a place in the community. All of a sudden, you're president of this company, so they want you on the bank board, they want you on the museum board, you're on church boards or synagogue board. You're just involved in the community where you're active. When that goes away, you have perks. You go to the football games. It's just your whole sense of personal. What do you do, and what do you? And so in the book, it talks about that, and it talks about you need to retire to something. And you need to have purpose in life. And this is candidly, this is my purpose in life is family business consultant. It's really like the fourth phase of my career. Right. And so I do this as much for two reasons: to give me purpose and to try to help other family businesses not end up selling their business. And I find it very enjoyable. So that's my purpose. Some guys' purpose, some of my buddies are hunting and skiing and golfing and fishing full time, and that's fine. But some of people are not consulting or they don't have purpose. So, it creates a real problem for them in terms of their happiness. And the same thing when you transition, kind of the same issues. If you're going to transition to the next gen, what's going to happen to the prior gen? Are they going to mop around the office and be disruptive and, and challenge and everything and, get in your way? Or are they going to have something else to do? So that's a pretty important part to work through when you're thinking about selling or transitioning to a next generation.
Yeah. Let's talk about, and let's have a conversation a little bit about my book, which is Disruptive Successor, which is the notion that there's a next gen leader that's aspiring to take the business to the next level. But there's a lot of times where there's a lack of certainty that this next gen leader is a capable and competent leader to take the business and grow the business. I'm sure you've been involved in consulting in those situations with family members, and you have to have some difficult conversations around that, I imagine. It's
interesting, quite often the parent will realize it too. It's not like the father or mother who runs the business doesn't know the capabilities or strengths and weaknesses of the next generation. I fall back into governance, having good governance to help through those kinds of situations. And by good governance, I think it's critical to have some objective outside independent directors or advisors on your board. Advisors are just fine where they don't have any real voting power, because it's not about voting. It's about guiding the board and the management and the family down the road and asking the right questions and helping steer the ship and influencing them. It's not a matter of their votes. So, if you have a board committee on working on succession, there are things you can do. There's for the individuals, you can work on getting them better training and exposure through either training or giving them a piece of the business, a small piece of the business to run to see how they can develop their skills.
Right.
You can hire, like we did, kind of for a lack of an alternative, we can hire another interim president. Really wasn't supposed to be interim, but he was interim.
Right.
And buy time for the next generation. But the real solution is to develop that next generation, find the people that have the skill, and give them experiences over 5-7 year period to be able to take on more and more responsibilities. If the power is totally controlled by an authoritarian leader, that's just not going to happen, and that's the problem. And so
it's tough also when they are not willing to let go of the baton. I mean, I have heard of and seen some businesses where the founder is in their 80s and still showing up to work every day and have no succession plan. And, actually, if a recent episode of 60 Minutes was interviewing the second gen leader of Scholastic magazine, and he is in his early middle 80s. He looks quite fit, and he admitted to having no succession plan in place. I mean, doesn't that scare you as a consultant going into a situation like that where, a fit 83-year-old doesn't have a succession plan, or maybe they're not telling you about it, but.
Well, the succession plan probably is a sale.
Yeah, probably.
But what really bothers me and what really saddens me, and it does happen more often than you'd think, is the 45 or 55-year-old son who's vice president of something, and he's like, "When's it my turn?" My dad will not back off, and so now he's in a position where he spent 20-some years in the business. Tough to quit and go find something else.
Yep.
He's kind of trapped. And that, to me, is the saddest of the situations.
I've seen that over and over again. They're too afraid to leave and go start something on their own because it's too late. They don't want to go into competition with their family, and they become sort of neutered a little bit in their power.
Neutered a lot.
Yeah, right.
It can be a real lot if you have a strong entrepreneurial leader.
Which affects the family relationships, which probably affects their primary, like their marriage and things like that. So very challenging. All right. George, why do family businesses matter?
It's funny. I've become a really big fan of family businesses. As you can tell, I didn't start my career in our family business, and I had every opportunity in the world to do so.
Right.
In fact, that was what was expected.
And I imagine, based on that bias, you advise your clients to make sure that their kids go out and get some job experience that if and when they come back to the family business will make them a more valuable player.
That was invaluable, particularly from the point you said, but also, having self-confidence and pushing through, because believe me, it wasn't just, there weren't all cheerleaders standing around me with my family when we're disrupting the way things had been and doing things differently. I mean, it was supportive and so on, but there was plenty of days where, one of my board members said, just keep pushing through. And, all the charts looked all great. Everything was going well, but, there were a lot of questioning and challenging and so, because we made big changes and cultural changes and
right.
So having that experience and success elsewhere was really critical for me to feel that I was on the right path and knew what I was doing and it was the right thing to do. In fact, I've said, not to diminish the success that families have, but when your name's on the door and you have, you end up on third, you get a home run and you started on third base, that's nice, but
right. I
got more confidence in a way from being judged by my very smart peers at Deloitte to be admitted to the partnership.
Sure.
As in terms of my competency than I did leading the family business and growing it significantly, just because I inherited this great company and a lot of things there were a lot of things that were the wind behind our back. So
very
working outside is 3 to 5 years, I like to say at a minimum, with one demonstrated promotion or some success track record, so they feel good about themselves.
Excellent. Good point. And I think the confidence is never something that I've focused on. I usually just focus on getting the experience, but I guess confidence comes from that experience. So, self-confidence is really important to
if you want to make change and lead, you have to have some confidence, particularly if it's
Yep.
some questioning.
Yep. All right. So as we start to wrap up, tell us a little bit about your business consulting practice. I've had a number of guests who are experts in family businesses, and some are focused on global businesses, some are focused, some are back east, some are overseas. How does someone choose a family business consultant, and why should, maybe let's start with the easy question, is why should they choose a family business consultant over just a regular business consultant?
Okay, that's a good question, actually, because there's the nuances are different.
Mm-hmm.
Having been both, I guess, it's much easier consulting in a non-family business as a consultant.
Of course.
Right, for the obvious reasons. And so, and part of the reason I'm in family business consulting is a couple of reasons. One is because I'm really committed to family businesses as a really smart thing to do for families to maintain.
Mm-hmm.
And two, I like the complexity. Kind of the other side of your brain gets worked.
Right.
So because you have all the business issues in a family business, but then you have all the family and family dynamics issues. And so it's quite complex. As far as choosing a family business consultant, there's no shortage of family business consultants out there. It seems like everybody's a family business consultant these days, which is fine. What I think is really important and what I value is people that have been CEO of something beforehand. So people know what it takes to implement change, to manage an organization. And so my bias is that they've actually had real world experience,
mm-hmm.
hopefully in a family business
mm-hmm.
setting, or board member experience in a family business. I've walked that walk, and I grew up on the same street corners with my cousins, and I heard how they talked about their father and their role in the family business and expectations, and that's been invaluable to me to really kind of live the life of a family business guy, both early on and then actually working in it. So I think that's an important criteria. I think having a fair amount of experience. I mean, if a guy's a 1 or 2 year family business consultant, that's probably not going to doesn't have enough experience to really be as effective.
I think, honestly, as someone who has read about half of your book at this point, I highly recommend it because I think it's a great reference manual, as well as it really covers the structure of business issues, family issues, conflict, talking about governance and succession. I haven't yet gotten to those chapters, but you really cover the entire spectrum of why a family business is different than a regular business. So
I thank you for saying that. That was my goal. It was I think it's 240 pages, not 400, and it was written to be, here's the issues, here's why it's an issue, and here's some suggestions what to do about it. And it's actually being used in one university as a textbook for family business. And I would love to get them. I would give the books away for universities just to have a chance to to impact the next generation of family business people, because it was written to try to help shape the conversation. Back to your question, and as references are also important. I think when you're a family, as you know, when you're a family business advisor, you're almost like the family doctor. I mean, it's a very special relationship. You have very private conversations. When I get involved with these clients, it's hard not to be like personally connected. They'll share stories about their children or their estate plans or their concerns about wealth or friction within the family and this and that for. So you really have to have a good connection with the family business advisor. Both, you trust him. Is their style appropriate for you? Are they good listeners? I mean, I always say my job is to listen first and consult second, because the cultures are so important. And so when you think about hiring a family business consultant, what I would be looking for is how many questions they're asking you, as opposed to you should do this, you should do that. And that's where I've seen a difference. There's a textbook approach, but a textbook approach should be pay based upon performance and responsibility levels. Well, I have a client today where the second generation of two brothers, and they get paid exactly the same. They have the same ownership, same perks, and the business has grown really well, run really well, and they have lunch together every day. Now, am I going to go in and say, "Hey, you guys are doing it all wrong. This president should be making more than you, Mr. Vice President"? Of course not. But the textbooks, but people would say, no, this is not right. And the next generation, the cousins, I'm actually working on doing that. We're getting benchmark compensation levels, coming up with incentive pay plans, and they are significantly different. But that's the culture of the different between the two generations. And so, understanding their culture and listening is probably the most important skill, in addition to having experience.
I couldn't agree more, and I bet you learned a lot working at Deloitte, where they're probably masters of asking really great questions. So
it was a great training ground.
I'm sure it was. All right. So your business, your family, your legacy, building a multi-generational family business that lasts by George Isaac. You can pick up the copy on Amazon, as I did. George, how do people get a hold of you?
A couple ways. One, real simply, if you remember my name, it's georgeisaac.com. There's more than you want to know about me there, and contact information.
Great.
And that has my email, which is gisaac at GAI Capital. And
Great.
my phone is 805-969-6602. And I work basically through Zoom at this point in time until COVID gets better.
Right.
But I'm dealing with anybody in the U.S. principally.
Exactly. Oh, great. Okay. And all that information will be in the show notes. So thank you very much, George, for being a guest. Obviously, you are a experienced veteran of family businesses who really understands the full gamut. So if you have a large multi-generational family business, probably a middle market and above, George is a great go-to resource expert who, again, here is local to me in Santa Barbara. So this is Jonathan Goldhill with the Disruptive Successor Show, where we help next generation leaders of family businesses take the business to the next level. Thank you very much, and stay tuned. And if you like this, share this episode, put a like on Apple Podcasts, and share it with friends. Thank you.
Thank you for joining us on the Disruptive Successor Podcast. If you enjoyed today's episode, please subscribe, review, and share with a friend who would benefit from the message. If you're interested in picking up a copy of my book, Disruptive Successor, go to disruptivesuccessor.com.